If you're ready, you can get started.
Give me a count off. Let's rock and roll. All righty. We live?
Yep, we're good.
Awesome. Hey guys, my name is Charles King for Penny Insurance, powered by InZone Insurance Services. I am your advanced case design specialist and annuity guru. Today, in this episode, we're going to talk about creating predictable income in retirement. What should you know about annuities? So, annuities can be fairly complex products, even if they're used simply. We like to make sure everybody's kind of educated and understands what are the features and benefits for annuities and why would you use them. We'll do a brief disclosure. This is for educational purposes only. This presentation is provided solely for educational and informational purposes. It should not be construed as an offer to sell, a solicitation of, or an offer to buy, or recommendation of any specific annuity contract, insurance product, security, or investment strategy. Information presented is general in nature. It is not intended as individualized investment, tax, legal, or insurance advice. Any examples, illustration, hypothetical scenarios, or product descriptions are for educational purposes only and may not reflect actual product performance or features available from any particular insurance carrier. Annuities are insurance products issued by insurance companies and are subject to the claims paying ability of the issuing insurer. Product features, guarantees, fees, surrender charges, riders, tax treatment vary by carrier and contract. For purchasing any annuity or insurance product, individuals should carefully consider their financial objectives, risk tolerance, liquidity needs, tax circumstances, and consult with their financial, tax, legal, and insurance professionals. No recommendation is being made that any attendee purchase, exchange, surrender, or replace an existing insurance or annuity contract based solely on the information contained in this presentation. If specific products, carriers, or strategies are discussed, such discussion is intended solely to illustrate concepts and should not be interpreted as an endorsement or recommendation of any particular product or provider. Past performance and hypothetical illustrations are not guarantees of future results. So glad we got through that. Guys, once again, my name is Charles King. I'm your advanced market case design specialist over at Penny Insurance, powered by InZone. I do know that that is a horrible picture, and I'm sure that I just assure you I don't look like that in real life. So, guys, what is an annuity? Well, an annuity is a long-term contract between you and an insurance company. There are two main types of annuities. So you'll have fixed and variable. Within those two product types, there are at least another 4 to 5 different flavors and sub categories of them. We're going to talk about the fixed side today. So moving forward, why people consider annuities? Well, people often choose annuities because they want more predictable retirement income. They want protection from market volatility with usually a cap and a floor, and they want income that they cannot outlive. They also are looking for tax deferred growth opportunities and greater confidence in retirement planning. As we kind of move down the road, as we get closer to that retirement date, we're more or less likely to want to kind of ride the ebbs and flows of volatile markets. We need some guarantees so we have an idea of what is our monthly income going to look like, how we're going to pay our bills, how we're going to budget, or how we're going to stay at a particular tax bracket and control Medicare and IRMA costs. Moving on. So, annuities may be worth exploring if you are approaching retirement within 3 to 5 years, want predictable income, you prefer less market risk, you want to be able to supplement your Social Security income, you value financial stability and guarantees, and are concerned about outliving your savings. So there are 3 phases of annuities in layman's terms. First part is contribution. You add money to an insurance contract. In the second phase, it would be the accumulation phase. It's where money grows tax deferred within that framework of the annuity. Maybe you don't need the income today, but you might need it in 5 years, 7 years, 10 years, 3 years, whatever the term be. You want to be able to get something from the dollars that you're putting into that contract for the interim time that you're waiting. And you want to be able to see at least some sort of return with some safety. And then finally, third is the income phase, which is often referred to as annuitization. You do not have to annuitize an annuity to get income off of it. You can take 10% within free withdrawal rates and within the surrender period, or after you are outside of that surrender period, you can take as much or as little income as you like. It is only after you go through the annuitization phase and annuitize that you would convert that benefit base to guaranteed payments for either a period certain for your life or for your life in another. The goal is to turn that savings into a bucket in which you can kind of turn the faucet on and start receiving income for a period of years or for your lifetime to help you with your retirement withdrawals. And moving on. So the first one we're going to talk about, very popular products, fixed annuities. They require a life insurance license to sell. They're regulated by state insurance departments. They do include some built-in guarantees, sometimes either with a fixed sub-account that will pay you a nominal interest rate, or would have a cap and a floor where you cannot lose money if the market is down, and then you would be able to capture whatever the pre-stated cap is for the upside return. It may include some early withdrawal penalties if you need to pull the money out in a case of emergency within the surrender period. Uh, and they may also include a market value adjustment in the case of, long-standing volatility, or we're starting to see the market kind of shift. They would be able to adjust those market values and then provide either a cash growth or a benefit-based growth, what the bucket of which you would pull money out through the annuitization process. They are compatible for qualified money like your IRAs, your SEP, any of those retirement accounts that are tax deferred and only tax when you pull income out, or you can also utilize them in a non-qualified manner for just a regular dollars that would be actually taxed at capital gains rates, either short term or long term, typically long term. Expenses and commissions are built into the interest rate. Usually, these things have, for the fixed side, it's called a spread. Usually runs anywhere from 1 to 1.5%. If you add a bunch more riders on, sometimes that can increase in nominations of 20, 50, 80 basis points, all the way up to 2%. On a variable side contract, it is called the M&E, or mortality and expense risk, that's bear by the company, and they will provide some fees that they use to maintain the contract for you. Expenses and commissions are also built into that interest rate. So usually they pay a commission to the writing agent, and then there are some ongoing fees that you pay for those guardrails of safety within the contract. They have a wide variety of products and riders available, from long-term care, the accelerated benefits, and other riders that can either increase your cap or give you more return or provide more safety, and have a mixture of different allocation strategies or sub accounts within that contract as well. They also are very good. They can avoid probate with a named beneficiary and have an associated death benefit with the residual of the contract. Or if you died before the annuitization phase, you can have that go directly to a beneficiary without it having to go through probate. So these can be very useful estate tools as well. Very, very flexible in their use. A lot of different ways that you can use annuities. So, types of fixed annuities. You have the immediate annuity. Immediate annuity is typically a single premium product. You're going to load up, let's say, $50,000 to $100,000, and you plan on taking the income within a year or within the year anniversary. That would be a SPIA. or a single premium immediate annuity. And then you have deferred annuities. Deferred annuities typically are waiting through a period of years, maybe it'd be 3, 5, or 7. You're looking for that contract to grow a little bit before you either choose to take income or annuitize. And these are traditional types. You also have some subtypes of that. You have the multi-year guaranteed annuity. That will give you a period of years at a guaranteed rate. What you see is what you get. No surprises. If they say they're going to give you 5% a year, you're going to get 5% a year. You also have a fixed annuity, which also works like a multi-year guarantee. It typically runs at a nominal fixed rate anywhere from 3.5 to 5%. It can vary a little bit with bond markets, but usually they're pretty well stuck on what they're doing. And those are used for pure guaranteed contracts. And then you also have a fixed index annuity. Fixed index annuity has a sub account that allows you to participate in the markets in the form of either aggregate bond market index, which would take whatever the performance is for bond markets, or typically a S&P 500 index that would mirror what the returns would be on the S&P 500. These are the most common. There are some other subtypes. We won't jump into those today because typically the fixed and the S&P are the most common. So, what if you could create your own pension in retirement? What we've seen with the kind of the death of the defined benefit pensions that we've seen over the last 20, 30 years. It used to be back in the day, you work for a company for a period of years, you're going to get a defined benefit plan through a pension, still offered in state and government contracts, but often in the private sector, we don't have as much. Now they've moved to defined contribution programs, which are like 401ks. What the immediate annuity converts is a portion of your savings into a stream of income that can begin almost immediately. Many retirees use immediate annuities to help create dependable income they can't outlive. They're really focused on maybe keeping their hands out of their IRAs or their other stock accounts in the first few years and need to know how to cover home and hearth through a period through that withdrawal phase as they retire. The pros of immediate annuities are they are guaranteed income payments. The income can start right away or usually within a calendar year. They can provide income for life. They reduce the risk of outliving your savings and helps create predictable retirement cash flow. Some of the cons, limited access to principal after purchase within that first year. The fixed payments may lose purchasing power due to things like inflation, as we kind of know and see every day. Maybe the dollar is only buying 35 to 45 cents of what it used to buy 10, 20, 30 years ago. They have a little bit less flexibility than traditional investments as far as liquidity, but they are made to kind of give you a safe ride through retirement. They may not keep pace with inflation as inflation and interest rates can adjust. That's another thing we kind of look out for. And you probably would consult with your insurance agent or financial advisor to discuss that. And also opportunity cost if interest rates rise later. Usually, when these contracts are issued, they are issued on the guarantees of the day that they are issued. They're not always going to give you an upside if the bond markets decide to, shoot way up on interest rates. You're probably stuck at the traditional rate of the contract when you signed it, when you got involved with it. There are also, in that case, possibility for exchanges or some ways around. However, moving on, the next one is a deferred annuity. Deferred annuity allows your money to grow tax deferred until you're ready to begin taking income. It can help you build future retirement income while protecting a portion of your savings from market uncertainty. Usually it does this through a cap and a floor. The floor is usually 0%. So if the market's down 6 points, you lose nothing, not a penny. If the market is up 15, usually caps out somewhere around 9 or 10%, you would capture every bit of that cap rate of 9 to 10%. Any of the excess, a lot of cases will go back to the insurer to provide them the liquidity to keep writing these contracts and make sure their actuarial formulas work for their guarantees that they provide to their clients. Uh, Another thing on these, the cons of them are surrender charges may apply for early withdrawals. One of the big things is if you're going to buy a 3 or 5 or 7 year contract, be mindful of, hey, if I don't need this money for 7 years, and we can let it grow in a deferred annuity and keep it in that bucket, you want to kind of leave it alone and let it do what it needs to do. Once that surrender period of 3, 5, 7, 10 years expires, you have kind of free withdrawals. You can do what you need to, take out as much money as you want, or choose to annuitize and take the payments for the rest of your life. Obviously, we've already kind of talked about how the growth might be capped depending on the product type, and early withdrawals may incur taxes or penalties. So you really don't want to be drawing out of one of these within the surrender period. And typically, this money, if it's qualified, it's earmarked for dollars that you wouldn't pull until after 59 and a half is attained of age. Um, Outside of that, we'll kind of move on. And a traditional annuity, typically these are the fixed, when we refer to a fixed annuity, that would be a traditional annuity. It's guaranteed interest rate. It protects you from market losses. It will grow tax deferred. It's predictable accumulation of retirement savings. They're pretty upfront about what percentage you're going to see, and there shouldn't be any surprises as you're approaching your retirement date. And they can provide some future income options. Now, the cons of these is lower growth potential than market investments or an indexed annuity, limited liquidity, just like any other contract in the annuity space during that surrender period. Early withdrawal charges would apply if you try to take money out, pre 59 and a half, or during the surrender period. And then inflation, once again, may reduce purchasing power over time. Returns may also be a little bit lower when interest rates are low. As we saw, 5, 6 years ago, we run a federal funds rate of like 2.25, probably being pretty competitive to get 3%. As we've seen interest rates go up, you start to see rates like 5 or 6% seem to be a lot more attractive for pre-retirees that are in the space. So, what if you could lock in a better rate than a bank? In most cases with MIGA, you can usually beat the rate on certificates of deposits and have free withdrawal periods of 10% within that surrender period, whereas the CD, you are stuck in that until the end of term. The guarantee of principal, if held through surrender period, typically is going to return exactly the interest rate that they promised you on the initial, solicitation of the contract. The guaranteed minimum fixed interest rate for them and the terms is not going to provide you a whole bunch of surprises. What you see is what you get with the MIGA. These are also going to grow tax deferred. They're compatible with IRAs and qualified account types such as a SEP IRA, traditional IRA, etc. And then they can be single premium or a flexible premium, where you can maybe add a little bit money over years 1 and 2 and kind of load it up with payments before you start to look to take income. The cons, once again, early withdrawal penalties from the insurance company, government penalties for withdrawals before 59 and a half, interest rate risk, inflation risk, and interest rate may change before the surrender period ends, as well as market value adjustments, which we talked about a little bit earlier. Moving forward, on the indexed annuity, which you've kind of talked to ad nauseum, you're looking at guarantee of principal if held through the surrender period, potential to share and earn interest from stock market index performance, typically the S&P, tax deferred growth. It's also very compatible with IRA, SEP IRA, solo 401k type money that is tax qualified, and once again, it can be single premium or a flexible premium where you can add some money in years 1, 2, and 3. Once again, the cons are pretty much the same. The only caveat are they are a little bit more complex than your MIGA or your fixed. They will have some other legalese in there that kind of can mitigate or cause you more fees for more riders, etc. So you really want to consult your advisor or your insurance agency on the features and benefits of these products and fully understand them before you sign that contract and move money into them. Four. And so, some of the great questions that you would ask your advisor before considering one of these is, hey, what's my retirement income goal? How much money do I need to net every month to pay my bills, take care of medical, and or supplement my income against what I'm already getting from Social Security? How much risk am I comfortable to take? Well, typically, if you're looking at annuity chassis, you're not looking at taking a whole lot of risk. That can vary a little bit with the variable side, but we're only talking about fixed today. When will I need the income? When would I turn the faucet on and start turning my payments on through the annuitization phase? And how is that planned to, kind of help me keep from jumping tax brackets in retirement and causing myself a higher tax bracket? That's another thing you want to kind of visit and look at. How long do I want that income to last? Do I need it for 10 years? Do I need it for 20 years? Or do I want a guaranteed paycheck for the rest of my life once I turn on the annuitization process? What other retirement assets do I have? Well, if you have a big IRA stock account, maybe you want to pull some money, put in an annuity. That way, stay in the market while it's ebbing and flowing, not having to lock in losses during that withdrawal phase because the first few years of your retirement are guaranteed for the payments for the annuities. There's also another strategy where you can ladder annuities at different places and increase income as well. And then every retirement plan should be personalized. You should use one of these in an overall plan and be able to kind of structure out what you need for income moving through that process and make sure that the annuity is going to provide for what your calculations for your either your tax advisor, your financial advisor, or agent have kind of provided you to cover what your budget is. So moving along, 16. I'll give you a real life example here. Susan, she's 65. She's got 500,000, roughly half a million in 401k. She's going to receive 2,200 a month in Social Security. Her concern is that the market volatility affecting those retirement withdrawals. So that 500,000 is going through some dips and some busts, and what happens is, she doesn't really want to start taking money out of 401k when it's dropped down to 400. She's ended up locking in losses. Well, the annuity gives her some certainty to where she can leave the stock market assets or the 401k alone and let them either come back to normalization or grow while she has some guaranteed money that sees her through her retirement. Um, Really, it's going to allocate a portion of savings towards that guaranteed income planning. And the result of that is greater confidence and a more predictable retirement income strategy. Moving forward to number 17, key components. Really, before you do one of these, you need to understand what your expenses are going to be. You're going to need to estimate what your Social Security benefits are on a monthly basis, identify any income gaps, evaluate any valuable assets that you can pull from or put into the annuity or use ancillary to the annuity for discretionary income. Explore other income solutions such as bonds or CDs or equity or dividend paying equities that can also supplement that income, and then create a diversified strategy that's a kind of a strong retirement plan that balances growth, income, and protection. So here at Penny Insurance, we're powered by Zone Insurance Services. We provide, counseling. We've been doing term and whole life policies for over 50 years and have a great back office. We really specialize in life insurance and annuities, but we also provide long-term care, disability, short and long-term, tax efficiency and tax mitigation services and counseling, corporate solutions for life, key man, buy, sell, exit planning, stuff like that. And then finally, retirement solutions is kind of my wheelhouse here as the advanced case design specialist. So, if you are interested in finding out more about annuities and how they can be part of your overall, retirement plan and bring you some surety in that withdrawal phase and make sure you have enough income in retirement, I am available to talk to you, be more than happy to kind of let you know all the caveats, the pros, the cons, what's the skinny on these contracts, and why you should or should not do them. I make myself available to you during the week from 8 a.m. to 5 p.m. Central Standard Time. And once again, that is Charles King. We'll have a contact here so you can get in touch with me if you need to. My email is cking@pennyinsurance.com. And my cell phone is 325-656-0024. Feel free to shoot me an email with any questions or give us a call or a text. I'd be more than happy to kind of walk you through the process and see if an annuity is right for you. Don't let that picture scare you. I promise you, I don't look like that in real life. And finally, thank you for showing up to our presentation today. Be more than happy to illuminate any questions that you might have and help you kind of navigate retirement and figure out what annuities can do for you and how providing a guaranteed income can make all the difference in your retirement. Thank you. And we hope to see you on the next episode over here at Penny Insurance, powered by Enzo.
Thanks so much for joining us today, and we'll see you next time.
Thanks, guys.